a channel starts to be compromised. Okay? Fine. So you see that solver starts to play around with that. And then I showed you the last one, which is that says, this again, this valuation measure. And in this valuation measure, we have this idea that here's a very direct valuation measure across all firms, across all countries, 50 countries, okay, which is the example that they did it for. And you can see that $1 of assets, book value, $1 of assets sells at $1 in a poor protection country, $1 of assets sells at $1.20 in a high protection country. So you are the same thing here. It's a 20-25% increase. So basically what you're saying is that I'm willing to pay 20 to 25% more if I have investor protection for the same asset. So this is the idea that raising capital at a 25% discount, it's amazing. Okay? So this is what's kind of like the graph that sort of like kills anybody. Okay? So it says like, okay, maybe I'll believe it. Okay? So that's kind of like that. Okay. And then we said, in fact, when you actually casually ask investors, and you're really willing to pay for investor protection, 90% of them say yes, and then actually they come out and say, yeah, I'm willing to pay about 20% more, okay, which is what I said, particularly like McKinsey, but they got it right this time, okay, so so they match that graph, so that's good, okay, listen, this is something that, you don't have in your hand out, but something that happened since I met you, okay? So this article came out from The Economist, okay? And it actually says, The Economist is trying to analyze what's happening in Korea. In Korea, there is a big revolution for investor protection. Because Korean firms, look at that, Korean firms there's about 50% of Korean firms in the stock market that are trading at a Tobin skew below 1. That is, $1 of assets is not worth $1. Okay? Mm-hmm. So this is like a big concern, okay? Because look at in the United States, very good firms in Europe, in Japan, who's been trying to revolutionize, and Korea now says it's very concerned about it because it's called the Korea discount. Okay, which many countries, Korea, they don't serious about it. So the government has been trying to put a campaign to really try to do this thing to themselves. I mean, just to tell you that this is not just fantasy. It's like people are actually working on this stuff, okay? Because it's a very good true. Okay, so since the president took over, the vice-president took over, Parliament has twice amended the Commercial Act. Okay. Managers now have fiduciary duties to the shareholders. The law has started to shift power towards minority investors. A little bit of the sensitive mechanisms that we have, okay, like mandating, for example, electronic shareholder meetings. Remember when we talked about proxy by mail? Okay, early on it says like, so to avoid UCOs that you don't let me into the room because I don't have my shares. Well, that's what, the Koreans, 20 years later, we're doing exactly the same thing, okay? Mm-hmm. I'm putting out Korea because this is going to be your case of Samsung, okay? So Samsung is all about what is going to be going on with Korea for the last 30 years, okay? And so then you can see that, there's movement around that, okay? So it's very practical in implementation, and investors want it. And activist investors are very strong on this stuff, because they know it works, they've seen it, they've looked at the regressions, and they sort of like say, this is what I should shoot for. Okay? So that's what we observe. Okay. Any questions? So that was my half an hour summary of everything we did in October. Okay? Any questions?
Sir, is that all the series based on your thesis, law and finance?
So the law and finance is the article that starts all of this literature.
Yep.
Okay? Mm-hmm. So actually it's very funny because now there are many masters in law and finance, okay? But that, in the year 2005, there was no masters in law and finance.
Yeah, because
that didn't exist, okay?
Yeah, because your thesis is published on the last century, right? Because it's been last century. Yeah, 1998, but yeah.
The first article is 1998. 1997 is the first one.
Yes.
They got the terminals in 98, but that was not my thesis actually.
Okay.
That was after my thesis. I did a thesis on privatization. Okay, in which I obviously said that the government did everything wrong, etc., etc.
Yeah, we have this word changed a lot and some serious
So
and
then, so
sort
a lot
of
of people. So the first articles are in the end of the 1990s. Okay.
Okay, 99.
And then people start looking at that, and then there is the first decade of the 2000s is all of this explosion of work in that. Okay, and the 2010s, so that's the 2000s, is mostly explosion on the shareholder side. Okay? So people explore a lot commercial codes and shareholder rights and so on. Nobody's really getting into creditor rights, which is debt, what we're going to talk about. Because, banks seem to be doing quite well, okay? And, what we said, listen guys, debt is exactly the same freaking thing, okay? And, and then here's the financial crisis in 2007, and then people start to say, well, maybe I should look at creditor rights a little bit further. And then, so the 2010s, big explosion on this idea of debt, okay, and banks. Debt and banks are the literature that explode in the 2010s, okay? And now we're exploring, now the thing that is working is how activists or large shareholders are using all of these mechanisms. So I would say that kind of like what's happening in the 20s. Okay? So this interaction, this mistrust for alpha. Okay, so what we say? So the 20s are about the mistrust for alpha, the mistrust about these two things, and the rebirth of the larger holders using these tools. Okay? If you want to see that, the larger holders are a big chunk of the problem. Okay? So that's where we end up a little later. Okay? So that's more or less how the literature has kind of evolved out of this. Now, throughout these decades, people have doing better and better and better indices of investment. Okay? And more models around what is behind it and so on and so forth. So law and finance is kind of like the beginning of the literature. Okay? So, any questions? Any other questions? No? Okay, so let's do that. The promised debt. Okay? Now, okay, so we have 2 hours and a half, right? So how does it work when I give 2 hours and a half? I don't give you a break? Yes, please.
Yes, please.
Okay, so why don't we, somewhere around when it's appropriate, around an hour and 10 minutes or something like that, I give you a 10-minute break, is that okay? And then we just, so we'll do that, okay? It's a little short. So that's what we're going to do for this week, okay? So we'll do a 10-minute break. You always make it into 12, okay, somehow, or 15, okay? So let's start short, okay? And then, the Spanish adjustment. The Spanish adjustment, okay, yes. Okay, fine. So that was kind of the idea of the law, okay? Now, as I said before, we didn't really get into just to remind you, is like I said, the law proved out to be incredibly powerful economically, okay? So it has economic significance, it's huge. It's not just statistical significance, okay? It's economic significance, like mathematical coefficients, evaluated mean, okay? All of that stuff is huge, okay? So that's why we put it from the strongest to the worst. So the most powerful economically to the most dangerous economically. Okay? Fine. So that was one thing I said about the list. So this guy proves to be moved. It was the new guy in the block, and then he moved to the top. Okay? But the second thing that it has had an effect that it has basically changed, okay, the way we looked at everything here in the list. Okay? So we used to think something about each of these mechanisms in the literature before the law, and now when we interacted with the law, the predictions change. Okay? So that's kind of interesting. So that's what has happened also in the last 20 years.
Yeah.
So we changed the early agency theory of the 1990s, which was all based on debt. Okay? And for example, in the early literature of the 1990s, the stars of the show were the large shareholders. And notice that they're way down here now. Okay? So they used to be the stars of the show. Right after that, these guys came up, and it's, it's completely changed. So this view about interacting this stuff with the law and financing has basically changed the ordering, and has changed a lot of the predictions that we used to have before and after. Okay? Is that clear? So what we'll try to do in the handout, okay, that's actually I was saying before, people teach full courses on boards. Okay, so you can teach a full course on boards, or a full course on incentive contracts, like executive compensation. Okay? But or banks or whatever you want. Okay? So but we don't have the time. Okay? We're Pamplona, and that means that everything is okay? Because you read at home, right? Okay, and then I'm just going to give you typically what I give you is kind of the idea, okay, about what's behind this mechanism, then the initial evidence on this, and then how it's turned, if it's turned, okay? So that you see what is the change, the big change that has happened, and some empirical predictions. Is that clear? The readings go a lot more in depth into all of this. So if you guys love boards, okay, well, you have tons of board papers to deal with, okay, and so on. Good. So you want to do thesis in any of these mechanisms, okay, you can always go deeper into each other. Is that clear? Yeah. Okay. Questions? Okay, so let's go into the debt, okay, the promised debt. So what is this idea about debt, okay? So debt is this, security, okay, that, people call it like the premier bonding device, okay? Because it creates a bond between the firm, between the manager and the firm, okay? The idea is that if you don't pay your debt, you go bankrupt, and if you go bankrupt, you lose your job. So that's a simple bonding idea, okay? So in governance, there's two kinds of mechanisms. There is bonding mechanisms, okay? Which just basically we write a contract and then we're bonded, and then if you break it, hell breaks loose, okay? Or there is monitoring mechanisms. So a board is not a bonding mechanism, it's a monitoring mechanism, right? So the board is there to monitor, okay? So, and some of these other things in the list, they have some bonding features and some monitoring features, okay? But I guess that is kind of like this premier bonding mechanism, okay? And the premier monitoring mechanism, if you want to look at it, is boards. Because, if you fire somebody, if somebody quits at board, nothing happens, okay? But the board is there to monitor constantly, okay? So those are the two legs of governance mechanisms in general, okay? Either you create a bond or you establish a monitoring mechanism, okay? Fine. So that is the premier bonding mechanism, okay? And before the law, that was at the top. So people agreed that that was the premier bond, the premier corporate governance mechanism because of the following. And the way I'm going to describe it is I'm going to pick up a paper that you have in your, like a classic, okay? Like a top classic, which is, this paper by Jensen, which is called the free cash flow theory of debt. Okay? So it's like, why does that exist? That exists because it controls agency. And it controls agency because it prevents managers from wasting the free cash flows. Okay? That's the bottom line. Now let's develop the whole thing. Okay? And you can always read the paper in case you haven't. Okay? So this idea of the free cash flow theory, that is the following. It says, listen, okay, think of a firm, okay, so let's just step back, think of a firm that produces a lot of cash flows, okay? More cash flows than what it needs to really take care of its own investment needs in positive and negative projects, okay? So think of a firm that is just, no matter what happens, it produces cash flows, okay? It's like a utility, like electricity. Okay, everybody uses electricity, no matter what happens. Okay, so you're gonna always have money in the pocket of the electricity field because everybody uses electricity all the time. Okay, so the example that he actually used, it's a fantastic one, Jensen. Okay, he says, think about a tobacco firm. Okay, and in this tobacco firm, think about a cigarette firm. Okay, so what does a cigarette firm do? Okay, it produces cigarettes. Okay. And people that smoke just smoke, okay, no matter what, okay? So if I tell you that you shouldn't smoke because it's going to kill you and your lungs are going to be destroyed, and I show you pictures in the cigarette, doesn't really matter. The people that smoke, okay? May deter some marginal consumers, but people that like the thing, they just smoke, okay? So rain or shine, and that's the idea, rain or shine like electricity, people that smoke, it's a habit, so they keep the habit, okay? So as a cigarette company, the manager of a cigarette company has a very cozy job because no matter what he does, there's a bunch of guys that are going to still consume this product the next month. Okay? If it's a recession, people smoke because they're very worried they're going to lose their job. Okay? And if it's a boom, people smoke because they have money and they go to parties. Okay? So whatever it is, you just smoke. Okay? Fine. So this is a classic free cash flow company. What does it mean by free cash flow? Free cash flow means that when I get up in the morning, I sell my cigarettes, people buy the cigarettes, the cash flows come on top of my desk, okay? Now, I take all of the cash flows that I need to invest in positive NPV projects, and there's still more cash flows left. That is, I have excess cash flows, okay? Now, the big question is, what am I going to do with these excess cash flows, okay? So this tobacco guy wakes up in the morning, if it's a recession month, who cares? The cash flows are there. If it's a boom month, who cares? The cash flows are there. Takes on positive NPV projects, and there's still free cash flows, or cash flows that are not needed for positive NPV projects that are left on the table. So the question is, what is this manager going to do this morning? Okay? What should he do with these free cash flows? Imagine that he's not infected with agency, yeah? Two things.
Make more money or give other people?
Well, he can't make more money because he's taken all the positive NPV projects, okay? If he could, yes, so that's why these are the free cash flows are after you take on positive NPV projects, okay? So definitely, first, make more money. Although sometimes it doesn't work that way. Well, first make some money, okay? And then give it back to the shareholders, okay? Yes?
But there's an dilemma because dividends are interpreted in positive.
Let's not talk about dividends.
Okay. But he talked about giving it to other people, and that cash is from the people who invested in the company.
That's right. That cash is the profits from the people that invest. So you give it back to the shareholders. Mm-hmm. That's what he's saying, right? You give it back to them. So it will be dividends or share repurchases or whatever you want. Okay? You need to give it back. Okay? Because you don't have a good use for it. You don't want to invest it in destroy value, correct? Because if you invest it in negative NPV projects, then what happens? Then you shrink the value. Okay? Fine. So now you should give it to the shareholders. But if instead of that, the guy is infected with the agency, what is he going to do?
Put it in his personal benefit pocket.
Well, he's going to try to put it in his personal benefit pocket of whatever form he wants. All the forms that we talked about, like you said.
Siphoning the money.
Siphon it out, maybe create an empire, diversify, all of that stuff that is not considered a big project, but that makes him more powerful. And this is the trick. Okay? The trick is that how do I control this guy? Okay? How do I make sure he gives the money back to me? And here comes debt. Okay? So debt is going to be, imagine that I get all the cash flows in the morning, I get up in the morning, get my orange shoes, okay? Cash flows come in, drawer opens, cash flows come up onto the desk, take up positive NPV projects, okay, orange shoes is off. Okay, now what do I do with the cash? He could have wasted it, but if instead of that, there's another drawer here that says interest payments, then he just has to puts the interest payments and the drawer shuts down. Okay? You've prevented him to waste the cash because he needs to pay the debt. Yeah. And if he doesn't pay, why does he pay the debt? Because if he doesn't pay the debt, then he goes bankrupt. And if he goes bankrupt, he gets fired. Okay?
But so whenever a manager has remaining cash flows,
Yeah.
he must get debt and then what?
This is what the debt theory would say. The debt theory says like, if you have a lot of extra cash flows, you need to impose a bonding device that prevents him from wasting the cash flows.
That can be debt, but not necessarily debt.
This is just one mechanism, not necessarily that. Okay, we're gonna talk about dividends, and we're gonna talk about that. Okay, but the idea of that is that, and the beauty of that is that debt is a very, strong security because it takes you bankrupt. Okay, so that's why people focus on debt because it has a high penalty. The penalty is very expensive. Okay. And in all of these models, in the bond, the trick about bonding models is the bond needs to be real. Okay, if it's a chippy bond, okay, then it's useless. Okay, that's what's going to happen to dividend promises. Okay, fine. So this guy says, then debt can be used to limit the availability of free cash flows to managers so that it commits them to make a repayment schedule. Okay, so now. So that's the benefit of debt. Yes, go ahead.
So is there evidence of tobacco, for instance, tobacco things that are highly...
I'm going to show you something. I'm going to show you this. I don't know if I have the case here, but if not, I will tell you like the best story in this. Okay, there's a real story in this stuff. Actually, there's a lot of evidence from what is called leverage recapitalizations, which I think I will mention here. That everybody people issue debt. They change stock for equity. It's stock for debt. Stock prices go up, like around 9 to 10%. A big leverage recap. Okay? This is what also happens with LBOs, leverage buyouts. Okay? So people, receive the LBO with grace because they say, finally we're going to discipline managers. Okay? And that's what happens with leverage recaps and so on and so forth. So empirically it's been shown to be important. Okay? And then I will tell you a story about a clear, one of my best stories about of the leverage recap. Okay, but that's kind of the idea. Is there any evidence on that? Yes, there's empirical evidence of that. Okay, yeah.
Does it matter what you use the debt for?
Does it matter what you use it? Yeah.
Investments.
So the idea here is that you had equity, and when you bring in debt, you're going to release some funds. Okay, and these funds you're going to be able to give them back to the shareholders. Okay. Now, if you use the debt to waste it, okay, then that's going to be another problem, okay? But if you wasted the debt, then you may go bankrupt. Okay, so this is the idea, You can waste the shareholders' money and you're not going to go bankrupt, but if you waste the bank's money, the bank is going to knock, okay? So that's kind of the idea. So you can waste it once, but you cannot waste it forever.
So yeah. I don't mean wasting necessarily, I mean like between financing operations, like regular operations with the debt, or maybe investing.
Well, financial regular operations is kind of like, to me it's equivalent to investing. Okay? You can finance your working capital or you can finance your fixed assets. That's the only difference. Okay? So there's no real paper that I can think of that makes a difference between these two uses of debt. That really complete this, okay?
So the question is on what would this under the assumption that you will have free cash flow, right? Because I just
noticed you have free cash flow.
But you have free cash flow.
Yes. So this is my tobacco firm.
And then you're still issued debt when you already have like liquidity.
No. So the shareholders are saying, okay, this guy is wasting my money. So how can I solve my problem?
So they have $200,000 of free cash flow sitting down at the project.
Yeah, so the manager has $200 sitting down there.
So I'm just going to issue, let's say, $100,000 extra money.
No, but you're not going to issue it because the manager doesn't want to issue it.
I'm saying, okay, so you ask for a loan for any financial entity.
The shareholders may force you to ask for a loan.
All right, so then you have $300,000, right? The $200,000 you have sitting on the deck plus the $100,000 you're getting. So what I just thinking on, you're increasing your financial expense.
Yeah.
But you're still not using the money towards project because you already.
So you give it back.
Oh,
So I issue 100 on that. In fact, if you have 200 left, okay, I want to issue 200 so that you give the 200 to me. and now you have nothing on the table. Because then the money is going to go in, the 200 that you had, going to the interest payment, okay? And then you didn't ask me for 200 to begin with, okay? I don't need to put 200 for the investments, okay? You kind of like giving it back to me, okay? So that's kind of the idea. The idea is that I leave you dry. So the optimal amount of days is the one that leaves you just dry on the desk, okay? That's kind of the idea. Does that make sense? Okay. So that's kind of the idea, okay? So this is the benefit of that, and this is what, the Jensen theory about that. That can limit the availability of cash flows, or free cash flows, so that it can go back into the pocket of the shareholders, okay? Now, so that's the benefit. But, in economics, there's no benefit, there must be a cost, okay? Otherwise, no equilibrium again. And then, so here's the cost, okay? The cost is that, what's the back my thing? Okay, so the cost is that, imagine that I issue too much debt, or that something goes bad in the world, okay? So, Trump arrives, okay? And God knows, I didn't know, I'm a Danish firm, I didn't know he was going to take over Greenland, right? So, now suddenly, this is a little bit of a problem, okay? So, the guy wants to expropriate all my cash flows, okay? So, now, suddenly, okay, the bad times come, and then maybe the bad times come, and maybe I don't have the cash flows, okay, to pay for the debt. So imagine that Trump or the Martians come, and then Trump says, "I'm going to expropriate all the tobacco plants in the world, okay, because they belong to me, because it's in the Americas, and tobacco works in America, so I expropriate all the tobacco plants, okay." So the Martians of Trump, which is basically the same shot, okay? So the tobacco plants go, and then suddenly there is no cigarettes, okay? So suddenly the drawer opens and there's no cash flows, okay? And then there is the drawer open that opens that says interest payments, but the 200 are not there anymore. So what do? You default. So this is why this liquidation may be costly, because you didn't leave any growth for financial slack, and you couldn't deal with Trump and his creditors, okay? So if things go bad, you may overdo it. So too much financial slack is bad because managers overinvest, but too little financial slack, it's also not great because you may kill the goose of the golden egg. It was a perfectly good company, it's tobacco, everybody smokes, okay? Just we had a Trump year, okay? Which was just like one of, yes, I'm taking over England, Greenland, or the tobacco plants, whatever, okay? So this is what in your basic finance courses, if you will, there's you must have seen that the benefits of that get exchanged with the cost of that. So this tax shield, which is a benefit of that, correct? Because you can deduct interest, it gets compensated with financial distress or bankruptcy costs, because debt may put you into bankruptcy distress. So this is what is called the optimal level, the trade-off theory of debt. Okay? So he picks up on the trade-off theory of debt, but it adds the agency channel. So in your early finance courses, you could have seen the trade-off theory of the debt, but the trade-off theory that is just about tax benefits of debt versus financial distress costs. Now he's saying that on top of that, the tax benefit of debt, there's an extra benefit, which is it reduces agency costs. So now you have two benefits and one cost, but the cost is still there. Not clear? Any questions? So this is what it says, so there's an optimal debt trade level, and then, the conclusion of that is this, in contract theory, okay, which I don't have any time to talk about, but in contract theory, they say, which is the best contract, the optimal contract to bind the firm, and they say, well, maybe senior long-term debt is an optimal contract because, short-term debt is blind, or bonds are blind, bondholders are blind, they don't know, they don't care about, it's very difficult to coordinate it, but senior lend by a bank, big bank, the bank can see you and help you in case, you find Trump. Okay? So the bank will understand, the bondholders will not, because it's just scattered and they don't know anything. Okay? So that's what says, well, maybe the best contract is senior long-term contract debt. Okay? Because it may allow us to balance this out. Is that clear? Okay, any questions? Okay, so let me just try to let's try to do together an exercise, okay? And you're not sitting in groups, right? No. Well, you can tell me your groups, okay? Okay, so that's fine, okay? So let's try to do this exercise so that you can see how it operates, because there's been a little bit of questions, okay? So imagine that we have an all equity firm. Let's start with a very simple case, okay? We're going to go and say, let's create a firm, a tobacco firm, okay, that has all of this cash. Imagine that this tobacco firm now is all equity, okay? Only has equity, so it's an all equity firm. And the firm expects cash flows of 50 in each of the next 2 years. So 50 this year and 50 next year. Does that make sense? Mm-hmm. Okay. So 50-50. So this is like my free cash flow that I get on my desk. Every the drawer opens, I get 50. The drawer opens, I get 50. No matter if it rains or shine. Okay? Now, in addition, next year there is an investment opportunity that will be available for you to invest 50 million in year one, and then you will get, in year two, you will get either 60 with probability 50% or 40 with probability 50%. Okay? Now, let's make it simple, okay? Imagine that everybody knows whether the firm has a good or a bad project before making the investment, okay? So this is a firm that has a project, this is a Danish firm that has a project in Greenland, okay? And it's planning to invest 50, okay? So maybe some tobacco is going to start growing in Greenland, okay? Because there's, there's meltdown. And it has this project, and you invest on it, it could give you 60 or 40. If Trump doesn't take over England, it will give you 60. If Trump sends the ships to Greenland, then it's going to give you 40. Okay? Does that make sense? Fine. And everybody knows if Trump is going to if Trump is going to send the ships or not, because Trump says, hey, I'm sending the aircraft carrier. He tells you. So you know the aircraft carrier is arriving to Iran, you know the aircraft carrier is arriving to Greenland, okay? So everybody knows before you invest, okay? So we take away the element of expectation, okay, in that sense, okay? Now, there's two kinds of managers, okay? Managers come in two flavors. So this example is like an example that is based on like the model that you would see there, in the model of the free cash flow theory of debt, okay? So now, but instead of equations, it's with numbers, okay? Or with letters, it's with numbers, okay? So now, imagine there's two kinds of managers. There's good managers, and these good managers only pursue positive NPV projects, okay? So this is a manager that is not infected with agency. And then there's the bad managers, which pursue good and bad projects, okay? So they do both, okay? So they take positive and negative. They are empire builders. They just want to grow, okay? Now, here's the question to you. Okay, you can do it with whoever person is next to you. How much is this all equity worth if it has a good manager? How much is this all equity worth if it has a bad manager, an empire building? And 3, once you solve these ones, okay, 3 is, which we can do later, okay, I just want answers for 1 and 2. Can investors increase the value of the firm by doing what's called clever contracting? That is, can they use debt to avoid the bad manager to take the negative NPV projects, okay, and only take the positive NPV projects? Could you do that? Could you tailor the debt to do that, okay? And how much will it take to tailor that? Okay, let's do 1 and 2, okay? Should I give you 2 minutes? 2, okay. It's very complicated, master level math, okay? So it should take about 5 minutes. Just be the value of the firm, when the manager is good. I don't know. You tell me, okay? The value of the whole firm, the value of the firm, and then the value of the firm with the buyer builders, okay? You need to play a little bit with probability.
Yeah.
A little bit of what the manager does. I need a number, okay? I don't want you to tell me more or less. I need a number in both cases. I need a number here, I need a number here. And if I were you, I would start with a number here. If you start with 2, then 1 is a lot easier. Yeah, were you going to ask a question?
Yes. So basically, for example, in case number 1, since you know already, you know if you're going to invest or not invest.
Yes.
Okay, yeah.
And case number 2 as well.
I mean, in case number 2, you're going to invest.
Yes. So you know.
Yeah. Okay. Yes.
Okay, so this is, I think you're too dumb to read it out, okay? You are totally too dumb.
I am done looking the number, but I
Just give me the number. Your reasoning is the good one.
okay. So,
怎么听见了吗？
Just write it down, don't ask. Don't tell anybody else. But you can tell
哦，你
yourself.
去那儿就是那个哦。
Okay, 2 numbers, come on, 1 more minute, okay? How are we doing? You're not writing, but you have a French called a math language. You're ready to write. So it depends on where you are. Depends on if he goes Trump sending the
谢谢。你可以给泰达先生跟他说清楚。
If you put 50 on your
Happy New Year.
Okay, I'm done.
Yes, now is the New Year. Wow. The first year, I'm experienced Chinese New Year, but I'm still studying. Fuck.
No, but we have like.
2 hours.
The thing is, the NPV of the project is interesting, you know, is.
Yeah, there's no interest rate, no discounting.
So that if both investors are risking drugs and the exchange is 0, then their difference between the project of
Manager gets about But the agency review of the world, okay? So the manager does, if it was done by an investor, with his own money, he would always take the positive, the right one. He would never take the bad one, right? Because it's his own money. But now if it's the manager who decides and is playing with other people's money, then he may not behave that way. Okay, 2 numbers. Do I have my 2 numbers?
5 and 8.
5 and 8. What do you mean 5 and 8?
What do you say? Resolution.
Yeah. No, it's not 100. No, it can't be the same. If it's the same, then I wouldn't be sitting here.
Yeah, it's not.
Okay, there wouldn't be
120 and 80.
No.
1 of 5 and 100.
1 of 5 and 100. 120 is too much. 1 of 5 is going to go way out there. 1 of 5 and 100. 1 of 5 and 100. 1 of 5 and 100. 1. So which one is 1 of 5? 1 or 2?
1.
1 is 105.
Okay, so tell me how you do 1, okay?
Well,
Let's do 2. Let's do 2.
okay.
Okay? How do we do 2?
So basically, first year is 50 million because that it's.
That just is the cash flows. Is the,
And second year, like with those 50 million, you can either make 60 or 40.
yes.
Like you can either invest for 60 or 40, and it's 50-50 chance.
Okay, so then he invests anyway, so it's a 50% chance that he gets 60 and a 50% chance that he gets 40. The world is either, we know that if the tank is already in the Atlantic or not.
Exactly.
Okay, fine. But he invests anyway.
Exactly.
Even if the tank is there, he invests. Okay, fine. Now, so that's the, and the good manager,
First year the same, and the second year there is a 50% chance of getting the 60 million in the case it's good, but if it's bad, he's not going to invest because he knows it's going to be bad, so he doesn't invest.
it's going to be bad. Okay, so then why is it 105?
Because it is
60?
It's 0.5 times 60 plus 0.5 times 50, it's 55. 55 plus the 50, 105.
Yeah, basically he doesn't invest here.
Exactly.
And he only invests when he knows that Trump didn't send the tank, okay, of their carrier, okay? So that's more or less what it is. So if it's an empire builder, the guy always gets the 50, okay? Every period he gets a 50, okay? So he gets a 50 and a 50. But, okay, in the second period, so this is the first period, he has 50 and 50, okay? Now, in the second period, okay, he gets his 50 with a 50% probability he's going to get this, with a 50 that one, so it's 100. Okay? But here, the guy, notice that here, he never invests in this case. He's a good guy. He knows, I'm not going to send my people to Greenland if Trump is already there with the air carrier. Okay? So why would I do that? Okay, it's a negative NPV project. That goes 105. So the agency costs are 5. So the difference between a good manager and a bad manager is 5. Okay, is that clear? Okay, so 5. So now he says, can I try to turn my bad manager into a good manager by putting some debt? Okay, let's see. Okay, so here, so imagine that now it's not a non-equity firm, it's what is called a lever firm. So it's the same firm, but now it has debt. So the shareholders put some debt there to try to control this guy. Okay? Now, the lever firm is identical to an equity firm, but lever has 50 million in debt, maturing in year 1, and 50 million in debt, maturing in year 2. So every year, the drawer opens and he needs to drop 50. Okay? That's the interest payment. Okay? Fine. Now, in year 1, leverage receives cash flows of, okay, 50 and pays to its creditors. Okay? It then decides, because I get my cash flows in year 1, the cash flows are there, when the drawer opens, the cash flows disappear. I don't have any free cash flows that year. So then I need to decide, should I invest in the new project or not? Okay? So, there's 2 scenarios. Scenario number 1 is the empire builder. So now we're talking about the empire builder. Okay? Because we know that my good manager never would have wasted my money. Okay? So no problem. My problem is I'm dealing with an empire builder. Okay? So this is why I put the debt. Now, with my empire builder, if he has a good project, okay, or my empire builder has a bad project, bad or good, okay? So now, how much is the firm worth if the empire builder has a bad project? Calculate raise finance. How much is the firm worth if the empire builder has a good project? Did my debt level work out to discipline the manager or not? Okay, 2 minutes. I need 2 numbers, okay? Okay. And it's not 5 and 8. It's not 5, it's not 8. Okay, so how much is the firm worth if the empire builder has a bad project? How much is the firm worth if the empire builder has a good project? Okay? My Mandarin row, okay? How is the Mandarin row doing? Okay, you all guys have Mandarins here, okay?
Yeah.
Mandarin, and Mandarin, okay? No, thank you very much. I love Mandarins, but... Okay, I need some numbers, okay? My row here. You have the 2 numbers? Well, let's
I need
work
one
on the
moment.
numbers rather than something else, okay? How much is the firm worth if the private building has a bad project? How much is the firm worth if the private building has a good project? Who has finished?
5?
Yes, no,
他说很
maybe,
喜欢
yes,
橘
no,
子
maybe.
Mandarin 橘子，普通话啊一个意思。Mandarin 普通话，因为橘子是中国人带过去。
Antes era, before it was a firm with an empire builder is worth 100. Now I have an empire builder, but I changed my capital structure. So it did my capital structure work. The key idea here is my capital structure to control my manager or not. That's what I promised you with that. Okay, I said that then would control the manager. Okay? And in order to do that, I need to figure out if values convert.
I mean, if he has a bad rate, he's not going to invest in it because he's not going to be able to pay the second rate.
It's not going to be able to be fine. Exactly.
So he's not going to work, he's not going to get it, he's not going to get good projects.
That's right. That's the answer. So how much is it worth?
That's the
As
worst.
before, you have the right model. Okay.
Yeah, now when it's
If he
coming,
has the right model, but he doesn't have the number,
Yeah.
you can give me the number, I have the wrong model, but I want the number. Okay? Any idea, guys? How are we doing? Not good. Isn't it bad? It's just half bad. Or half good. Let me positive. Let me positive.
这是什么呀？
Yeah.
哦，安妮艾迪，没想法。
Oh, so you want to capture this idea?
我以为西班牙语。安妮安妮。 他就说喜欢，你可以下课跟他说，就是说新年快乐，这是中国人给的。如果新年你中国人东西不要，会有不好的事情。就是 AI 直接提取他的那个视频，这个是最准的，比他自己都准，他自己都记不那么清楚。
the 50K receipt, they pay less. And then in the second year, he can ask for 50 only if the group project and he's going to get half of the But if not, if there's a bad rate, he's going to end up having no year.
So 10, so 50 chance of it.
I mean, zero in the bad project.
Okay, so we got that. So you guys gave me the number. He gave me the number, so let's look at it. Okay, here we go, guys, okay? This corner of the room is like, you know, this part of the room is lazing around, okay?
No, we are
With or without mandarins. Okay? Okay.
Do you want a Mandarin?
Okay, so
Okay, great,
imagine
great.
that the empire builder, the empire builder has a bad project, okay? So I'm an empire builder. But because you put them in my company
好
before,
没问题。
the 50 that came the first year, I put them in the drawer and they disappeared. Before, I used to have free cash flows. So I could use the cash flows to do my investment. Now I don't have them. So that means that I need to go to the capital markets. I need to go to the capital markets and tell them, hey, lend me 50 and I'm going to give you 40 back. And then the bank is going to say, sure. Okay, I'm not gonna give you. If I give you 50, okay, you need to give me at least 50 back. So the firm is only gonna get 90 in year 2, the 50 from the tobacco and 40 from the project, right? So then when he distributes, he's going to distribute 50 to the senior guys and only 40 to the junior guys that just raised the capital, okay? So the junior guys are going to say, hasta la vista, okay, we're not going to fund you, okay? You don't take the bad project. So then the firm doesn't take the bad project, okay? The firms with bad projects are worth 100, okay? Now, we move into the world of Trump didn't send the tanker, okay? So Trump didn't send the tanker, so that's a good project, okay? So now I go to the bank and then I say, hey, give me 50, Trump is not coming, you will get 60. And then the bank says, sure, that sounds like a good project, okay? It's non-Trumpian, so therefore, then you're gonna get 50 and 60. So I gave 50 to the old creditors, 50 to the junior creditors, and there's 10 left for the shareholders, okay? So this firm is worth 110. But because the world is 50-50 chance, that's the world of Trump, God knows what he's gonna do every morning, okay? It's a flip of a coin. So then, on average, the firm is worth 105. And now suddenly, what I have done is I have converted my bad manager into a good manager because that forced him to the constraints of new financing and capital markets. So now he cannot take the bad project, okay, because he doesn't have the free cash flows. Is that clear? Does it make sense? So that's what the model is in this here. So that's, it's more fancy mathematics, but it's basically what the model is about. Okay? Is this idea that debt is this hard commitment, security that forces you to pay back. And if you don't pay back, the bond breaks and then hell breaks loose. Okay? So that's kind of the idea of debt. So debt is the premier bonding device. And then you ask me, what is the evidence of this? Okay? And in fact, there's a literature about is debt a good bonding device? Okay, and probably the best empirical evidence of that is the evidence of leverage recaps. I have a paper there that is on leverage recaps. So what are leverage recaps? Any idea about what a leverage recap is? So it's a recapitalization with debt. Okay. So what leverage recaps do is you issue debt, and the money you get from the debt, you pay it back to the shareholders as a dividend or as a share buyback. So I recapitalize my firm by boosting the debt component and lowering the equity component. Okay, that's a leverage recap. And on average, the literature finds that firms that engage into leverage recaps, okay, that is, they do this exchange debt for equity, like a debt for equity exchange, the stock price reacts at 9 to 10% positive. Meaning that people see, here comes debt, here's the discipline, okay, the money went back to the shareholders, the free cash flows cannot be misused, here we go, boost up, okay? The same kind of idea is the idea of leverage buyout. You've not heard about leverage buyout, LBOs. LBOs are a massive leverage recap, so that I raise tons of debt, tons of debt, and with that I buy all the shares. So I buy out all the shareholders, I buy all the shares. It's a massive buyout. And markets also raise values like around even a little more, 10-12%. Okay? So that's kind of the idea that debt may be a good discipline device. Okay? So that's more or less, the idea about debt. Okay? So you can read about the empirical evidence over there. Now, I'll finish and I'll give you a break. Okay? So here comes the next thing. Now, let's interact. So this is, it's like, I haven't told you anything about the power of the bank or the power of debt. We've been assuming that banks are powerful. But we saw here that creditors are powerful in some places, but not powerful in other places. So now let's interact these two. So it basically says that in countries where creditors are powerful, debt is really a threat, and it's a good bonding device. But if creditors are powerless, because they don't have good bankruptcy laws, then debt is not a threat. okay? And it's not a good bonding device. So you see how now the whole thing changes, okay? So we have a new interaction to try to figure out, is that going to be more powerful in countries with high creditor protection or not? And that's what people want, okay? Does that make sense?
Mm-hmm.
Okay, great. Okay, so it's 5:20, how about 5:30? Okay?
Uh-huh.
Is it, oh, let me see, because that's...
10分钟，10分钟。
Yeah, it's 20.
19,
So 11 minutes, do we agree? I'm grateful.
Okay.
11 minutes, okay? Then we're going to talk about dividends next.
Dividends。
My guys,
麦克，
Happy New Year. 上一年好。Happy New Year, my fellows.
Happy New Year。
How did you say it in Chinese? 新年快乐。
Right. Yeah.
Así de aburrido está la clase.
Oh, what happened today?
Overslept. No worry.
Did you talk to Martha?
Yeah, I talked to him.
I talked to her. It's gonna be okay. I'm gonna do it
Tomorrow.
tomorrow morning. Yeah.
You present tomorrow, right?
Yeah.
I'm gonna be there watching you.
Yeah. Are you doing good? Yeah. You doing today or?
No, tomorrow.
Okay, great. Let's do it together then.
你明天不能再睡吗？
对的，对的，我今天9点就睡觉，5点就起。太可怕了！我一醒，我看见好几个未接电话，我的个老天爷啊！
对啊，我也打了
吓死我了。。
我 WhatsApp、微信和你手机号都打了。
主要是我睡得太那个什么了，那叫什么？睡得太死了。
对啊，你身体可能在保护你，觉得你不能。
对我6点，我说我躺一会儿吧。不行，一躺到12点了。
Oh, is it your birthday today?
I don't know, somebody said that. Okay, so it's my birthday today. What a way to celebrate with you.
It is your birthday.
Yeah,
Oh my
Happy
God.
birthday.
Happy birthday.
thank you very much. I chose specifically to teach you.
I can put on this. It's literally almost it's his birthday.
Yes.
Happy 30.
Okay.
Yeah, happy birthday.
Thank you.
A lot of things to do here, my brother.
Okay, any questions about that? Okay, so the same idea of debt is what people thought about dividends, okay? Oh, this is not the one. Okay? So, dividends, think about my manager. Think about my manager who receives the free cash flows, he has them there, and now, before there used to be a drawer that calls interest and payments, so all the cash flows go into the interest payment, okay? And then you say, why should I be paying the bank? Okay, and then he might take the bank. Why don't instead of that, instead of an interest drawer, there is a dividend drawer. Okay, so a drawer that comes, put all the money into the dividend drawer, and then he still has to go to capital markets to raise equity, okay, to raise financing. Okay, so that's basically the idea of dividends. And this is how the literature started with the dividends. In the early literature of dividends, they say, there's something that is called the dividend puzzle, right? We don't know why, we already talked about it, okay? We don't know why firms pay dividends because dividends are heavily taxed. Okay, they're taxed higher than capital gains. So why on earth would a manager pay dividends? So one alternative may be, well, maybe managers want to pay dividends because that has shareholders feel that they eat their pepperoni because we live in an agency world. Okay? So this is the idea of it's better to have a burning hand than two in the bush. Okay? So maybe dividends are this kind of like, bonding device that if I establish, that you need to pay me dividends, then I'm gonna be, in the same world as in debt, except that I will avoid the bankruptcy that the bank may throw into bankruptcy, but the shareholders will not throw into bankruptcy because they understand that Trump came and it was not your fault. Okay? So that's the idea of dividends. And then people started to say, well, let's try to analyze the dividend behavior. And we actually start to see that firms behave very particularly about dividends, okay? So this is every 5 years since the 1950s, okay? A guy named Littner has been running this kind of questionnaire from Harvard Business School. He's dead now, obviously. But, but he started this kind of questionnaire in which he started asking firms, how do you determine your dividend policy? How do you decide on what to pay dividends, okay? So this is the last interaction. Now it's done by a couple of guys in the United States, a very famous couple of professors that now do this every actually 2 years, okay? So they go and ask the CFOs of the top 500 companies in the United States. So the CFOs, so the financial advisors, which are supposed to know, they say, listen, how do you decide your dividend policy, okay? And then see what comes out of this, and it just happens all the time, okay? So it says, how do you set your dividend policy? It's like, so first, 93% of them say, 94% of them say, we try to avoid reducing the dividend. So it's kind of like, I have a dividend, I don't want to cut it, okay? Now they say, we try to maintain a smooth dividend stream. This is basically the same as this, okay? So we just try to, this is our stream, we don't move around, okay? Number 3, we look at the current dividend level, and that's how we set the next dividend. So that also says we don't want to move things around, okay? So the top 3 reasons of paying dividends, and the 4th one says we are reluctant to make a change that may have to be reversed.
Yeah.
So it looks like they're all saying, and even 5, okay? We consider the change in the dividend, so they don't want to move, okay? Rather than reducing the dividend, we would raise the funds to undertake profitable projects, okay? So the cost of external capital comes way down there. So it's all about, I don't want to move my dividends, okay? I'm sorry? Stability of dividends. So this points to people who it sounds like managers are really concentrated on dividends, okay? It must be that dividends are a tool that, appeases investors, okay? That they do that because they don't want to scare investors or something, okay? Now, so then they said, well, maybe dividends are a good mechanism for reducing agency costs, okay? Because then people see the pepperoni coming out, and then the people are happy, okay? So that's the classic, that's the standard way of doing that, okay? That's how, the first way to look at it. In fact, when you go back in history, okay, so this would be like, 150 years of dividend payments in the United States, which is the longest series that we have, okay, so you can say that, in fact, firms do pay a lot of money on dividends, okay? So if you take the dividend to price ratio, which is a lot more unstable, well, let's take the dividend to earnings ratio. So you can see that firms paying around 40 to 50, okay, or 40% on earnings, okay? So this says it sounds like managers are focusing on dividends and they're paying a lot of dividends, okay? So that's the classic one that people said. Well, maybe right after that, dividends are the next strong mechanism of corporate governance, okay? Because sounds like people are focused on them, investors like them, and we see the evidence that people have been paying dividends like forever and ever and ever. Okay, great. And then comes K, investor protection. So now we move with let's do investor protection now. Let's move around the world and let's see, in an international perspective how things work. Okay? Fine. So people seem to be saying dividends are similar to that, okay? It sounds like it's similar, but first line of attack is, but do they really have the same commitment? Okay? Do they really bond you the same way? When I don't pay my debt, I go bankrupt. When I cut the dividend, what happens?
They may fire me, but maybe I can promise to increase it then later.
Yeah, so they may fire you, but they need to all be coordinated to fire you, okay? Once that happens, the stock price goes down, okay? And you do not know, you cannot tell if the dividend cut was because of Trump, okay, or because there's an exogenous reason, or because of a bad behavior. So it gets a little bit more complicated. So unless there is a large cost to cutting dividends, the dividends are not going to be as much of a commitment as debt. That's the first line of attack. And then the second line of attack is, let's look at K. Okay? So let's look at investor protection. Now we're in the 2010s. Okay? There's a paper that you have there that is called Agency Theory. Dividends and agency theory around the world. Okay, so something like exactly what it is. Okay, agency theory of dividends around the world. I forget what it's called, but you have it in your business. Okay, so this is a paper that does this. Okay, what this paper does is it says, okay, there's two soups in the world. Okay, either you're a high K country or you're a low K country. Okay, high investor protection, low investor protection. Okay, so you could be high K, and you could be low K. Okay. Okay. Now. Okay. So now I'm a high K and a low K. Okay. Now imagine that so now I have high dividends and low dividends. Okay. If I am so there's two theories here. Okay. Theory number one is going to be the substitution theory. Okay? So the substitution theory says, okay, well, let's put it this way actually. I think it's going to be simpler if I do it this way. Let's call this substitution theory. And let's call this one outcome theory. Okay? So, if dividends are a very good corporate governance mechanism, okay, I may use them to substitute for low K. So, imagine that I am a firm in a low K country. Okay? So there is very small investor protection. Okay? Then what I'm going to do is I need to send a signal to the market that I'm good. So what am I going to do? Pay high dividends or low dividends?
Low.
If I'm in a low K country,
Under the substitution theory,
under the substitution theory,
then you pay higher dividends.
high dividends because you need to substitute for the low protection, right? So here, if I'm in a low K country, okay, I'm in Peru, just randomly, okay? So Peru has low K, okay? So that's how she knows, okay? So now, okay, so it has a low K, so the firms want to get money, but the low K of the place doesn't allow them to get money, so they need to step up. So they need to pay lots of dividends, okay? And if you're in a high K country, do you need to pay high dividends or not?
No, you can pay low.
You can pay low dividends, okay? Okay, so low dividends. And then you pay high dividends. Right? Because investors already feel reassured. You don't need to pay them dividends. They will always get their dividends. Okay, the law allows it. That's the outcome theory. And this outcome theory says, dividends, great corporate governance mechanism. Okay? Fine. Now the outcome theory shows up, and then the outcome theory says, imagine it's like you guys that are thinking that you can substitute law by dividends, you're crazy, okay? You can only get your dividends if you have high K, because high K is the one that is going to force the manager to give you the dividends, because only in high K there is a high penalty. In low K, just like in there, if there is low K, then I can't force them out, just like a bank, okay? So, what does this outcomes theory predict? Where our dividends are going to be high? Here or here?
High.
So, dividends are going to be high here, okay? And dividends are going to be low here.
Perfect, but in practice we see that substitution theory coming up, no?
In practice, that's the empirical question, and that's what the paper actually tests. So the test, the paper is Agency Theory of Dividends Around the World or something like that, whatever it's called, okay? It goes and says, do we observe this world of this world. Okay? So how many people think that it's the substitution one? So you think it's solid?
Yeah.
How many people think solid?
Hmm?
How many people think it's the substitution theory that wins? 1, 2, 3, 4, 5, 6, 7, 8.
I'm saying I did not get the outcome.
You didn't get the outcome theory, okay? Okay. It's difficult to vote. It's difficult to vote in that case, okay? So, the substitution theory is clear, right?
Yeah.
I substitute low K, I make up for that. The outcome theory says there's nothing to make up. If you're in a high protection country, dividends just flow because these shareholders are very powerful. Okay, they have high K. Just like in high creditor protection countries, banks are powerful. Okay, so this is in high K countries, shareholders are powerful. Okay, so you don't need to pay dividends. Okay, in fact, in the outcome theory, okay, because shareholders are powerful, okay, that's where they get the dividends. And here, if the shareholders in a low K country, you're never gonna see your pepperoni, okay? It's never coming out of the pizza, okay? Because, and if it doesn't come out, what are you gonna do? Are you gonna cry? Well, let's cry together, okay? It's not gonna work, okay?
No, what I was thinking is that
That's what the theorists said.
the companies still have to make some lobby to get some K because if no, there's not going to be any capital market in Venezuela.
Well, the market, well, you can try to make a little bit, but the question is, how is in the end, what is the line up on average, okay? I agree with you that the pressure is here, okay? The pressure is here, so you would say, these guys are going to need to make up, okay? And so now that we understand everything in the world, how do we vote? Who says substitution? Substitution, sub. So like half, more or less, okay? Who says outcome? 1, 2, 3, 4, 6, 7, 8. Who hasn't voted?
The missing.
The missing, okay. So fine. So let's look at the evidence. So this is the non-regression evidence. You can go through the regressions in the paper. This is a very simple table 2 by 2. Okay? Okay? And then we're going to try to figure out here, okay, which evidence. So this is the paper, this Journal of Finance paper that's called Agency Theory and Dividends Around the World or something like that. Okay? Now, what we have here is it's a very simple, this is the 2 by 2 table. Again, you can look at the regressions, it's all the same. Okay? So then they say, let's split the world in two. The high investor protection countries and the low investor protection countries, okay? So who is high investor protection country? We saw that it was common law. So we're going to put at the bottom, we're going to put common law, okay? And at the top, we're going to put civil law, okay? Which are, in general, the low investor protection country. And in fact, when you look at the numbers, if you create a value, if you're above or below median investor protection, because you can see that these guys are above the median, and these guys mostly are below the median. So this is the average countries, is civil law is a low investor protection, and the average country here is a high investor protection. Okay? Yeah. So now they go and they look at the dividend policy of firms, okay, through time, all of the publicly traded firms in each country. Okay, so they see how much they pay. Okay? And then they control for firm characteristics, blah, 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 all of that stuff. Okay? And what do we observe is we observe that on average, so there's 3 ratios of dividends here. Okay? On average, we observe that a firm in the world pays dividend over cash flows is about 11%. Dividends over earnings is about 30%, okay? It's a little bit similar to the graph that I showed you before in the United States, okay, on average, okay? And then dividends over sales is about 1%, okay? And now let's just do this simple split, civil law versus common law. And what do you observe? Okay, that, in civil law countries, which are low investor protection, you pay 10% of cash flows versus 18, 25 versus 37, 0.8 versus 2. So which theory wins?
Common law.
Outcome, okay? So outcome wins. Okay?
Outcome.
Okay, so basically it says, and then you can go on regressions and control. You're going to control for growth rates, because of course growth rates of the firms matter. You're going to control for blah, blah, blah. Taxes, very important. This is this column that is called the dividend tax advantage. That is, you pay more dividends if they are less heavily taxed than the capital gains, and so on and so forth. Okay, so you can see that on average, dividends are tax disadvantaged. Okay, they're below 1. Okay? And in the US, they are very heavily tax disadvantaged, for example. Okay? And the perfect country for the world, which is Argentina, okay, has a 1. Okay, they're exactly the right policy. That's before Millennium. Okay, so God knows what that's that.
They got one thing right.
Yeah, they got one thing right. Okay, yes. Okay, so you control for all of that, blah, 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 and you still get these very significant differences about dividend equity. Okay, so in the end, dividends turned out to be an outcome of K. They are not an independent governance mechanism. So the value of dividends so it says, don't focus on dividends. Focus on K, and you'll get dividends as a byproduct. Okay? So you notice how that has changed completely. Is that clear?
Yeah.
Any questions?
Florencio,
Yes.
what about a blend that takes into account
The
expectations?
blend.
Yeah.
Okay?
Because like firms don't want to disappoint their investors' expectations because of the impact it's going to have on their stock price.
Yes. Yeah, but in the end, that's what comes out. In the end, they value more money in their pockets, okay, than disappointing investors, because investors are powerless. This is what this is saying. Okay? So this is why firms have a very hard time finding or raising capital in many countries. Okay? So because K is very low, and even with dividends they can't. Okay? Even with dividends they can't. Because think about it, you are an investor. Okay? So I pay you dividends for 3 years. Okay? And then when the crisis hits, and boom, I cut out the dividends, and they tell you, bye-bye, I fooled you once, okay? So, it's a very hard model to sustain because the penalty in the end, okay? When cap T arrives in the model, when cap T arrives, you take it out, okay? Good. I think that's one interpretation of that, okay? So maybe I'm moving along, but then in the end, when the crisis hits, then I do that. Any questions? Yeah.
About the graph, the numbers. The numbers.
The table.
About the table, the numbers represented in each country. For example, the dividends over cash flow percentages. It's all medians, no? As it says
I think
above.
this one is the medians.
Yeah.
This one is the medians.
Okay. Yeah.
So this is a test of medians, okay? And then the paper runs regressions and all of that stuff, obviously. Okay, but this is just like a simple way of showing numbers and so on.
Yeah.
Yeah.
So these theories were made before the evidence.
Yeah, when you're writing the paper, you write the theories, okay? So you're thinking about,
Like
let's translate.
hypotheses.
Yeah, the hypothesis. So you're in the middle of the dividend puzzle literature, and you observe the previous theory, the previous status, and then you say, how do I interact this status of dividends with my K? Okay, and then I say, well, theory 1. We made it up, okay? So we call it substitution. The counter-efficient called substitution. We just called it substitution. And the other one is called outcome, okay?
Yeah.
But we just called them, nobody had written the theory before, and then we tested it. It was made up there and then tested in that paper, okay?
Yeah.
Now there's many papers that do much more stuff about dividends and so on and so forth, okay? So again, what I did is, let's talk about classic dividends, new way of looking at dividends, okay? Is that clear? Okay, we've done law, debt, dividends, boards, okay? So great, okay? So why are we bothering here? Isn't that the reason number one where we have a board is that the guys are going to be monitoring the managers, and then they're going to be just making sure that everything is just right, okay? So why bother with all of this other stuff? That's why we pay people to be in boards, right? Boards are the primary mechanism of, okay, agency control because they monitor very closely. The manager needs to go, tell everything to the board. They can take decisions, they can block management, all of that stuff. And the board is actually voted by the shareholders. So we have a perfect mechanism, okay? Except that the evidence of the boards is pretty bad, okay? So in principle, the manager should be accountable to the boards. That's the theory, that's what it says, okay? But what do evidence really finds? The evidence finds that boards really do nothing, okay?
Nothing.
That's the case of Samsung.
That's one example of this case, exactly, okay? So boards really do nothing, and for many reasons, okay? And so people have tried to figure out, first do they do something, and there's a literature on boards of directors that, there's thousands and thousands of papers for every single country in the world that you can dream about, twice, okay? And so this literature goes back, okay, it starts in the 1990s, really, some late 1980s, trying to figure out boards. It's the early agency stuff, okay? And people are figuring out whether the boards do really anything. And it's very hard because it's very difficult to see the day-to-day of what a board does, okay? So it's very difficult to see, well, maybe they stop that all by itself, but we don't see it because it happens in a private room, okay? So that's why people are trying to figure out how to test for the efficiency of boards, okay? There's basically two main reasons why boards don't do anything. There's two buckets, okay? Bucket number one is going to be, why would the board guys be the goody-goodies of the world? What makes you, the moment you become a board member, you're the goody-goody guy, okay? But the manager is the bad guy, and then the board member is the good guy. This is kind of like the same idea of models of courts being efficient. Why would the judge be good, okay? There's no reason why the board guy wouldn't be good. Why wouldn't the board guy have his own agency problems, right? Yeah.
And what if I hire board members, external board members?
So we will see what people do. So people say, but remember, shareholders vote for the boards, okay? In principle.
So yeah, but some companies like Facebook, right? Mark Zuckerberg has over 50% of the shares, right?
So we're going to get there. That's bucket number two. Let's go to bucket number one. That's bucket number two, okay? Let's go to bucket number one. So bucket number one is going to be, okay, I'm a firm with lots of shareholders, and the CEO is powerful. I don't really have a dominant shareholder, okay? So what happens in these situations? Well, in these situations, probably my manager is the one that calls his friends and says, hey, would you like to apply for the board? Okay, guess what? I can put your name on the list. If you're any smart, okay, you would probably call your friends and not your enemies to sit in your board, normally. Okay, you wouldn't call your worst enemies to join your board, okay? And then the shareholder process of voting is complicated, and God knows what's in the list, and that may get elected, okay? So the idea here is that in practice, okay, directors may have their own agency problems, and their alliances may be compromised for the CEOs. And people find, in fact, okay, for example, this is a very famous case that says, when the statistical evidence suggests that usually the board colludes with the CEO. So whenever there's a takeover threat, the board colludes immediately with the CEO and says, no, let's not take the takeover, okay? Because if the CEO gets fired, the board gets fired, okay? So they also have their own pocket, okay? Now, and this is what happened, for example, in this Trans World. This is the largest takeover of an airline, which was Trans World America, which is now, after several iterations, Delta, okay? So this is Delta, okay? So in practice, directors may be reluctant to challenge the CEOs because, they're kind of friends, okay? So why would you like to challenge your friend that brought you to the board, okay? And in fact, there's evidence in those papers that look at, let's look at the board members that went against the majority, okay? These loose cannon guys, okay? Well, they disappear, okay? So next year, they're not there, okay? Because people start to say in the board, you're not playing like a team guy, okay? It's like, why do you want to go against us? You don't love us, It's like, and then people just go, okay? So there's a lot of evidence that directors who disagree with the majority are actually asked to resign. Hey, you're not happy, just go. Okay, and then they go, people go. Okay, so that's the first kind of bucket of reasons. The reasons that CEOs in this widely held firm, for example, dispersed firm, they don't tend to do great. Okay, board members. Okay, and here's like the classic paper. Okay? So this is the #1 paper that really established that and starts to deal with external directors. Okay. So notice this is like the classic, okay? So this is a paper that is looking at firms in the 1970s and 80s. So this is in the 90s, and we're looking at a decade with, a decade of what did boards do. And the nice thing about this paper is that they say, how can I know what the board is doing? It's very difficult to figure out the minutes for the board. So let's say, let's try to classify companies in buckets based on the idea of companies that really, really need a board action. Okay? So we're going to try to identify a bucket of firms or a couple of bucket of firms where the board should really take action because everything is going terrible. Okay? Because if you're a firm in the middle, God knows. But if everything is going terrible for the firm, that's when you expect the board to react. Okay? So what they do is they look at the New York Stock Exchange firms, and then they say we're going to create 10 buckets, so 10 deciles, okay? In decile 1, decile 10, okay, I have the gods of the world, okay? This is the 10% of firms that are outperforming the market, that are outperforming the market by 70%. So these are the gods, okay? So no problem here. The 9th decile, they're outperforming by 37%, by 20, by 11. Here we get to the median firm, it's about 0. And then here are the losers, okay? So here's the bunch of losers, okay? These guys are underperforming by 30%. So you're underperforming the market by 30%. You would expect that at that point, the board would say, hey guys, this guy is really a loser, okay? So we need to get moving, okay? And then you would say, so what they look is they say, the firm has underperformed the previous year by 30%. What's the probability that the manager is going to get fired the next year? Okay? So, imagine that you are in bucket 1 or 2. Okay? You're underperforming by 30, 25%. What would you say is the probability that the board will fire the manager? 80%, 70%, 50%, 20%? Without looking at the table, just think about it. I tell you, the firm is underperforming by 30%.
For how long has it been underperforming?
A year.
A year.
Less than 50% chance.
Less than 50? That's a very big number. Less than 50, okay?
Depends on how much it's underperforming.
On average, it's underperforming by 33%. In this bucket, the average underperformance is 33%. Is that not good enough for you?
We should kick it.
Go out.
They are not going to kick it.
Manager, a cobrar subsidio al paro.
Okay, so they're underperforming by 33% in returns. That's not bad enough for you?
Yeah.
If that is not bad enough for you, then I don't know what's bad. But
And I'm a bad business owner.
You're a bad business owner.
I'd expect for that to be like repeated because sometimes there's exogenous economic.
No, but that's what we play on averages. That's what we play on averages, guys. We're gonna then control for blah 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 blah. Don't give me econometrics, okay? Clean the econometrics. What would the coefficient should be like?
Sorry.
Okay?
70% or something like that.
Yes, okay. Controlling for everything else. 70%,
Okay, so then I would fire him 100%.
100%,
80, 90%.
80, 90%. No? Well, 6%. 6%. So this is the percent, and this is the implied probability for this bucket. The guys get fired 6% of the time. 6%. Okay? And it is true that the gods are fired less. They are fired 3%.
Yeah, but only half less.
But only have less, right?
Yeah.
And you listen, I'm a god and you fire me 3% of the time. I'm a total loser, I play golf all day long. You fire me 6% of the time. I might as well just play golf all day long. Okay? Yeah, it's like the delta is going to be incredibly small.
Really bad incentives to be a god CEO.
Really bad incentives to be a god. Okay? So that's why, CEOs play very well golf, okay? They're doing golfers, okay, and tennis players, okay, fine. And then you say, so this is more or less, this basically averages the evidence everywhere, okay? So this tells you it's insignificant, okay? The guys are dying and they get fired 6% of the time. It's like, please, okay? Boards do nothing, okay? So this is the boards in the United States. Do you see that? Okay, fine. But then you say, and this is why I like this paper, and this is the way to present it before regressions, okay? We'll do regressions in a more paper here. Next, okay? So now we say, okay, but not all boards are made equal. So it goes back to your point. There's boards which have outside directors. So before it used to be called outside directors, now they're called independent directors, okay? Okay, those that represent minorities, so independents, blah, blah, blah. So let's classify the boards in 3 buckets. In this bucket here, less than 40% are independent. So more than 40, am I right? Percentage of outsiders, less than 40, yes. So this is an insider-dominated board, right? Because 60% or more are insiders, like the friends of the CEO, the family of the CEO, friends and whatever, or insiders of the firm, the CFO, the CEO, or whatever, okay? Fine. So they're all here. Because remember, the CEO also sits on the board, and the CFO also sits on the board, and all of that guys are good there, okay? These are boards that are kind of 50-50, and these are boards that are outsider dominated. That is, 60% of the firms, the firms have more than 60% of independents or outsiders. So if the independents get together, they can win and they can fight. Okay? Is that clear? Okay. So for these guys, what do you think would be the probability that in the loser bucket, okay, you fire the CEO? They will tell me 200% now. Right? Okay? Well, it's only 7%.
7%.
So the outsider-dominated boards, with every tool that they have in the world, they can fire people at 7%. Okay? Now, and if you look at this guy versus this guy, that's not statistically significantly different. Okay? So basically, boards do nothing. Okay?
Why are they there in the first?
There are big puzzles in life about institutions. Okay? So, how do we pay them? That's a very big question. Okay? Okay, remember, what the outcome is going to be is there's no perfect corporate governance mechanism. Okay? So there always needs to be some combination of stuff. Okay? But is the board going to solve this? No. Probably not. Okay? So now this is the classic paper. This is the #1 classic paper. Okay, let's do something more modern. Okay, so something more modern. Let's take another episode. Okay, so people then shall go back to the 2010s. Okay, and 50s, and we say, well, we heard this stuff in the 1990s. I guess people have learned, right? So now it's all been published. So now this is a paper that is looking at what happens to CEO. This is probabilities of firing the CEO. I'm reading because you can read it. Probability of firing the CEO, okay, when performance is bad. Okay? Again, the same thing. But now they're focusing in a period, 1997 to 2005. This is the corporate governance crisis in the world. So you would say, in this period where everybody says this is a corporate governance crisis, okay, and particularly it's an executive compensation crisis, maybe at this point, boards actually react. Okay, there's a corporate governance crisis. Firms are collapsing. Okay, maybe the boards are going to react here. Okay, now, in fact, so now we're going to run regressions and we're going to throw the kitchen sink. Okay, so this is all we control for returns, for industry returns, for life returns, for blah blah blah, for interaction with the company stuff, and then a lot of company fixed effects. Okay, anything you want. Okay. And we control, and then what we have is here, this is our variable, okay? The variable is no independent board indicator. So this means, no independent means that this is an insider-dominated board. So an insider-dominated board basically doesn't fire the CEO statistically significantly different than 0. Okay? Now you throw out tons of interactions. You can always run regressions with 1,000 variables and maybe one will come out. Okay? And then you get this variable that says, yes, the outsider boards fire 3% more than other ones, with a 10% significance. Okay? This is exactly the same as this. Okay?
Yeah.
This is exactly the same as my friends here did. Okay? So it's exactly as there's a 3% difference. Okay? And this is controlling for everything else, we're back to nothing. Okay? If you have an inside dominating or controlling for everything else, nothing is happening. Okay? And you may say, well, maybe these guys don't fire then, because we stupid guys that are running regressions, we don't understand everything. Okay? We don't see all the stuff. We cannot control for enough company characteristics. Okay? There is unobservable variables in our regressions. Okay? And we cannot really do anything about that. Okay? Well, here's another paper, that actually says, actually firing these guys is freaking good. Okay? So this is what this is what's happening. So this is a CEO turnover, good or bad news. Okay? So the guy said, this is the total sample. So whatever is total sample is this is the day when you fire the CEO. This is an event study, right? Okay? The day you fire the CEO, okay? So this is this is here, no? No, this is the day, sorry. So this is the day, okay? Okay, because there's another one that has yearly variables of financials, but this is the day return. And then you can see here that the day you fire him, markets kind of go up, okay? But slightly, but then it gets better. When it's a voluntary retirement or firing, that guy retired, okay? Because CEOs never get fired, they always retire, okay? You never say, I fired the CEO. It says, oh, our CEO has to retire because he now wants to play with his dog, okay? And so this is when it's truly voluntary, that is like the guy was really retiring, okay? So you can see there's no effect. When it's a firing, you can see that the effect comes there. And this is, if you focus on forced departures and prior performance, you can see that forced departures and overperforming, that's bad. Forced departures and underperforming, that's what you get on the returns, 6 to 7% returns. Okay? So it basically said the market knows, okay, which guys are getting fired, and then it's good to fire them. Okay?
Market prices for the firing.
Sorry?
The market price of the firing of the CEO.
Yeah, so this is the market price of the stock when you fire the CEO. Okay? Fine. Any questions? No? Okay. So boards, bye-bye. That's reason 1, okay? Here comes reason 2. Let's put on the international benefits. This is your bucket, okay? The bucket is, what about if there's a large shareholder, like my, whatever, Google, Amazon, any guy you want, okay, now in the industry, okay? This is what people call family firms, okay? Firms that belong to the families, and this is a international evidence. So let's forget about Mr. Gur or something, let's go back to Sweden, okay? Sweden, Sweden is a very good country. Somebody from Sweden, right? Mm-hmm. Not yet, okay? Then you marry into someone there. It's a very good family to marry into. So here is the family that owns half of the stock market in Sweden. They are called the Wallenbergs. Okay? Take note of that. What you have in your house class. No? Okay? If you come across a Wallenberg, it's a good business. Okay? So they own these firms like SAPS, they have Atlas, Electrolux, AstraZeneca, Ericsson, all of that is there. Okay? This is how much they control. And here's the generations of Wallenbergs, okay? So this is Grandpa Wallenberg, okay, and the 2 sons, and then there's going to be other ones, okay? How do their boards look like, okay? So look at, this is sort of the company. So here's Grandpa's, okay? Oh, you cannot really see anything, right?
Try turning off the light, maybe.
Now you're asking for something incredibly complicated. Okay?
No, I don't think
Oh.
Okay, it's gonna come back, okay? So here's Grandpa, Peter Wallenberg, who by the way just passed away, okay? Now look at the board. Okay, they don't look very happy, okay? So look at the board, okay? Look at the board. So Peter Wallenberg is the vice chairman of the bank, but he's also the chairman of Asia, of Atlas, of Ericsson. Then son number 1, Jacob Wallenberg. He's the deputy chief officer of Eniska and also in the bank, and he's a member of this, and that. Here's Marcos, he has the cash. He controls Investor, which is the investment arm, and he sits here too. So it's like a family lunch, okay? And here's another guy, Klaas Danbach, okay? What on earth is he doing there? He's in all of the boards.
Married to a daughter.
He married a Wallenberg, okay? So he did the right thing, okay? So if the son-in-law is part of the board, okay, now you're done, okay? There's nothing really that you can do, okay?
So the husband is part of the board, but the daughter is not part
The
of the
daughter is not.
What time was
Go to
it?
practice.
because she is blood related. So you have your quota of blood related.
I want that.
He is not blood related. Here you go, okay? I mean, the wife of this guy is not on the board, but you don't seem to protest to that.
But she's the daughter.
She's happy
You
not being
know,
the board.
daughters, daughters-in-law, we all love them the same way, okay? So now, okay, so this is the Wallenberg, so that you can see. Now, this family is very famous actually, okay, because they figured out everything that they need to do to own a country, okay? So the combo, they go back to the 1600s. So the combo is, you need a politician and a banker. This is the combo. Politicians and bankers is the explosive combo. So you can see here, there's bankers and politicians all over. Here is the guys that we just talked about, Peter and Mark. They have kids, okay? Some of these kids are a little bit older than you, okay? But I found you the new generation, okay? So this is an article of the new generation of kids, and I found you pictures of some of them, okay? So these are the old kids, but now this is the kids that are on your block, okay? So these are potential targets. Okay, fine. So basically, family boards look like Christmas dinners, okay? So why would you fire grandpa?
Yeah.
Of course not, because grandpa would then cut you from the will, okay? So of course, you're never going to fire the CEO because grandpa is on fire, okay? Any questions? So boards are a complete disaster, okay? So now we're down to every time we're going down, it gets worse and worse and worse and worse, okay? So it's not improving, okay?
Up to dividends is sufficient.
Up to dividends, we have 2 strong mechanisms, and the rest is a bunch of difficulties, okay? So, alpha, let's go back to our alpha. This was very important, right? Alpha was our main mechanism that Jensen identified in the first theories of agency. Alpha goes up. Remember my airplane when I told you insider alpha goes up, then you don't buy the airplane, okay? Yes, remember that? Okay. So that's the kind of idea. There's a linear relationship. As alpha goes up, you waste less because it costs you more, your private dividend pocket, that's what our model said, okay? Some people have tried to measure that. And that's what comes out of that, okay? So this is a review paper of the early generation, okay, before 2000, when we haven't figured out that alpha is actually endogenous, okay? So people are still thinking that alpha is exogenous, okay? And they find, all of this kind of stuff that, seems to go. So this is what we have here is insider ownership, alpha, and here we have Tobin's Q, and you see that it's just kind of like a zoo. Okay, depending on the regression model that you use, what you're going to find. But when it does come out, it doesn't seem to be linear. Okay, whatever you do, it doesn't really seem to be very linear. Okay, so all of these studies put together do not give a strong view for alpha. Okay, but in all honesty, they all don't use the same technology. They don't all use the same profit measure. They don't all use the same ownership measure. So it's kind of like crappy. But the most important, probably the biggest problem that we're going to have here is that actually ownership structure is endogenous. And that's what we're going to see at the very end of the handout. Okay? Is my alpha is going to depend on K. So what am I bothering with this? The ownership is actually endogenous. Okay? But let me just, so that I review the early part of the evidence. Notice here that when you start to use some kind of model that allows for changes or something, you can see that it seems to be up and then down and then up. That's more or less what it goes up and down, okay? Or something seems to be going up and down here. So people started to think about this in this way. It's funny because Jensen said it's linear like that, so it should have been aligned like that. It doesn't seem to be like, it seems to be go up and down and then up, okay? So this is one of these papers here, okay? So this paper says it's because, nonlinearity is part of this whole thing, okay? Because alpha is going to be a very strong mechanism at the very end, because basically if you own 99% of the firm, it's like you're stealing from yourself, okay? So it makes sense that it's high here, and it's probably going to make sense at the beginning, because this is when I give you more and then you feel the pain and then you want to incentivize. But here comes a very dangerous middle, okay? The middle is this range, okay? So at high, and at very high and very low, maybe Jensen works. But in the middle, this is like what is called the entrenchment, the entrenchment level. It's like, I have high enough, I have 20, okay? So that it's good for me to do self-dealing, and still, it doesn't cost me that much. So there is this level when I have enough alpha to organize all the self-dealing, so I can do it because I'm powerful, but still low enough, okay, that it still pays for me to do self-dealing. Okay, so this is this middle range. You see? So basically what this is saying is like, let's be very careful. Not because you give more alpha to your manager that he's going to behave better. You give him a lot of alpha, he's going to move here. And then he's going to be able to organize a hanky-panky. Okay? Is that clear? Mm-hmm. So in the US, people calculated this range to be, between 5 and 25%. Outside of the US, people have calculated this more to be like, around 30 or 40%. Okay, up to 30 or 40%. Okay? So we see this jag behavior. Okay? So ownership works, but it doesn't work all the time. Okay? Is that clear? Good. Any questions? Okay. That's what I'm going to do today is incentive contracts. Okay? So now you say, well, I'm not going to give him alpha, but I'm going to give him some incentive so that if he improves the performance, he gets more money in his pocket. But now I understand that alpha is dangerous. Okay? I don't want to give him ownership. I just want to give him another incentive. And this is what the literature about incentive contracts is about.
That's a bonus.
I'm sorry?
That's a bonus.
It's like a bonus or some stock options or something that would sort of like turn him to incentivize him to do the right thing. Okay? And this is probably the key paper in this literature. So this paper was done by Jensen and Murphy, okay, from Harvard Business School. And then they say, okay, do we give them enough incentive? So back in the late 1990s, so these guys are writing this paper, they think, maybe we don't, early 1990s, maybe we don't incentivize our managers enough. We should give them more when they do great, okay? So they go and measure how much managers make when they increase the value of the firm. And they come up with this very famous number, okay, which is called, for every $1,000 they increase shareholder wealth, we give them $325. Okay? So I make you 1,000, you give me 325. Is that little? A lot?
It's a 0.325%, just a bonus.
Yes. 1,000 is 0.325, yes. So then you can interpret it the way you want it, okay? Depends on how much money you make. Okay? But, okay, it looks like a little, right? The way it's presented, it doesn't sound like a lot. Okay? And so then they say, probably, this is good enough to restrain them from wasting money in perks, but probably not good enough to avoid large negative equity projects. So maybe we don't incentivize them enough. And guess which paper is one of the best-seller papers from Harvard Business School in the world? Okay? It's paper. Because every single manager in the world wants to buy a copy of this paper and give it to its board and tell him, see, Harvard says you don't pay me enough. Okay? And then that actually was one of the key papers that fueled this huge increase in manager compensations in the 1990s, because manager compensation in the form of incentives, because we were not paying them enough. Okay? So now notice that here, executive compensation is a solution to the agency problem. And when I presented my first set of slides, executive compensation was a manifestation of the agency problem. Remember, we saw that with the Deutsche Bank guys? Okay? So what do people think? Okay, so then let's just try to do something so that you can see how executive compensation is this very complicated animal. Okay, so here we are. Okay? Question number 1 for you. Okay? What happens to the price of the stock when the company pays out a dividend? Let's go back to Finance 101 when you were
The price
kids.
increases. Well, at the ex-dividend date, the price increases, and then it
At the announcement date,
No, at the ex-dividend date.
when you pay a dividend, does it go up or down? Who says up?
The price
You
goes up.
recapitalize
The price goes up or down? Up? Who says up?
After
Who says
It's
down?
up.
after paying the dividend.
Yeah, when you pay the dividend, the ex-dividend
After
day.
paying the dividend or the date of the announcement? Or the-
No, when you pay the dividend. It's,
When you pay the dividend,
Yeah.
then it goes down.
yeah, when the announcement was, I showed you that in my study, right? So why does it go down? When you pay the dividend, the price, why does it go down?
You're decapitalizing the company.
You take money out of the firm, right? So the shareholder used to have, okay, here, the firm was worth this amount, okay? And now you're gonna pay this as a dividend, so the value of the firm goes down. Now the shareholder, has he lost or not? Because
Because he's taking his part in the
that's
dividend.
right. So before I got, my pie was all here. Now I have my pies minus 1 slice, and I put my slice here. I should be equally well off. That's what Milano Digliani would say. Correct? Fine. Now, so it goes down. What happens to the stock price when the company buys shares back for the same amount? It's going to buy, imagine that this was, 100, okay? I'm going to buy back 100.
With no premium.
No premium, market price. What happens to the stock price?
It's going to increase. Now there's less shares in the market, so you need to increase the price so they represent the exact same amount of it.
Okay? So I took out 100. Again, I'm going to take out this slice, okay? So now I bought, imagine that this pie was worth 1,000. Okay? So there's 10 guys, okay? So now I took 1 guy out. Now these other guys, are they equally well off or worse off?
Yeah, they're equally well off.
Okay? So they're going to be equal. So the price should stay, or if anything, kind of go up. Okay?
A little bit.
Okay. So that means that when I pay the dividend, price goes down, and when I buy back, price goes up.
Yeah.
Now imagine that my CEO, I was one of these smart guys that read the Harvard paper and said my CEO is not enough compensated. Okay, I need to compensate him more. So I'm going to give him some options to incentivize him so that he can buy shares at this price so that he boosts the price, and then he's going to want to make the difference, the delta. Okay? Options. Okay? So imagine that my CEO is sitting in a bunch of options to buy shares at the price before the company decides what they should do with the dividend policy. So what does my CEO want to do? Does he want to do dividend payments or does he want to do share repurchases?
Want to buy?
Share repurchases,
Yeah, sure.
right? Because that's how the price goes up.
Yeah.
He doesn't want the price to go down because then he's under the water. So just to tell you that, executive compensation is going to determine what he does, okay, on the thing. So it's not going to be so clear, okay, when I introduce this noise, okay, it's not going to be so clear what he wants to do. He may use dividend policy and other tools to gain, So executive compensation may give him tools, okay, to bring more money into his pocket. In this case, that's the case. Is that clear? Okay, that's just, just to turn just on that. Okay, fine. So now, what do people say about executive compensation? Okay, I think I should let you go. So when we come back tomorrow, I'll talk about exciting people like, Obama, okay, and my friend, okay, Elon Musk, okay?
Oh, God.
So we'll talk about that tomorrow, okay? So we'll see what happens really with executive compensation. Okay, so tomorrow I will definitely finish, okay? I will definitely finish this handout with ownership tool. If you want to read something tonight, because I think it's going to be incredibly important to read something that's called corporate ownership around the world, okay? Because that's what's going to be about large shareholders later, okay? And you're going to need it for your case. And then on Thursday, I will start with valuation, okay? So I'll give you a case to read, which is called the Nelson Paper Problems case. We'll read it and then we'll solve it together, okay?
Okay.
But see you tomorrow at some time, right?
See you.
It's the same hour.
Same hour, okay.
Same hour, same range. Sí,
那你晚上还去吗？你晚上还去？你还跟那个他说吗？就你不去了？
今天晚上我们先看个小本会，我先看看明天去什么节目。
哦，你是说明天不去是吧？
对。
哦。
今晚
就是那个披萨会。那个是去干啥？那不是可以去吃东西吗？
对啊。
那为啥不想去啊？
我不知道，现在狂欢节嘛。
哦，是因为狂欢节所以才没法去，不是不想去。
对，我想去的，但是这个狂欢节很难得。
那个狂欢节都是干啥的？啊，你发给我了，好像我去找找。
来搜一下。
好。
那晚上最有名的，
哦，
最古老的。
原来是这样。What? She said it's okay. She understand that because I doing that for a whole night. Yeah, so I can do it tomorrow.
Very nice
Yeah, it's okay.
Yeah, I told you she was gonna.
Yeah, she's nice.
Yeah.
Very nice.
Yeah.
Yeah. Thank you.
Nah, you're welcome. So you prepared it well?
You mean I prepare when?
You prepared the presentation.
Yeah.
Now you have it well prepared. Was it worth it? The whole night?
Yeah, it works. Yeah, because I do a lot and practice. Because I'm gonna do like a 40 or 50 minutes.
Yeah.
It was stressful for me, honestly. Yeah.
But in China, did you do many presentations?
No, in bachelor, no.
No.
Yeah, we're just studying. We're just having lesson like now. Yeah, answer the question, do the homework, pass the examination. Yeah, that's it.
Presentations, no.
Presentation, maybe when you graduate, before you graduate, maybe you have one, like a final TFM, but in a other time, no.
Yeah.
So, but maybe in a master, you have to do it all the time.
Yeah.
The semester or PhD times, you should do. Yeah.
It's an officer something electronics, ¿verdad? Porque como que it's an out cuando preguntas que corporate structure, por ejemplo, para Samsung Electronics.
Es un conglomerado.
Claro.
Tocini.
Bien.
Sí, eso lo
O sea,
veo.
al final las cosas pasan por técnica.
Estamos usando orden para sacar
¿Cómo
la
puedo yo hablar? Yo ya te digo, me sigo queriendo ir a China igual. O sea, eso no. Si algo ha mejorado.
Vale, sí, no, right now.
Porque ahora ya me voy a ir a China sin presión, a hacer que es lo que hay.
A la esta.
Hello. This is a customer service consultation service.
How are you?
Yes.
You're still this morning.
This morning
So you were gonna die.
I was too because I don't know what happened. I felt like I was.
Exactly. That's
对，我要去买水啥的，啥也没有，一般吧，一般，不如那个雀巢的那个1块1。
Ahora vamos los 4 juntos.
Goodbye.
Voy al servicio. Ve al servicio.
Bye bye.
Bye.
Entonces, lo de la pierna, ¿qué pasó con la pierna? Que jugando a fútbol la semana pasada le pegaron una patada en la pierna. Entonces el pobre lleva casi 10 días que le duele el pie y la pierna le duele el cojillo. Entonces ha pedido que esto de poli.
Bye.
Y eso.
Hi, my good. Where were you this morning?
Sleep. I'm overslept because I practiced the presentation for whole night, so I was.
Oh no.
But it's okay because I have chance tomorrow. I have sent her email, so it's totally fine. Don't worry.
他说什么 Did she say anything bad?
No, just understanding and say sorry, but like it's okay, totally okay. Tomorrow we can do that again, so it's fine. Bye. Have a nice day.
你用什么理啊？发烧？
我就实话实说，就是说弄了一晚上。
哦，那挺好的，就是实诚一点。
对，实话实说。
他也很愿意理解。
对。
这个老师挺好的。
对对。
天了，忙死我。
对。
我今天上午其实也一直在睡觉，因为我逃避现实。
对，理解。太难了，这太多太复杂的东西。而且今年还过年。
就是。
过年还不清静。拜拜。没有，你说。一口包出来。Yeah, thank you.
It started today, no?
Yeah, Chinese New Year.
Chinese
Just
New Year.
yeah. Wait, let me see. Just an hour and a half ago.
An hour and a half ago.
Yeah, it's Chinese New Year.
And what is the
Animal.
you have an animal?
Yeah, mine is dragon, but today is horse.
But so each year it's an animal.
Yeah. This year from today, horse.
It's a horse.
Yes, from beginning it's a mouse, ox, tiger, and bunny, and dragon, and next.
Okay.
So the story is 12.
And all the in February.
No. It's on the traditional calendar.
Okay.
So every year is different. Even we are 12 months, but sometimes in a Western calendar it has 30 days, but we have 28. But sometimes it has something else. But so around February. No, sometimes not in the month. Yeah, January to February, within the six. It's not sure.
And it becomes like 26, or you have another year?
No, we just use the 2026, or we don't have counting ways.
Okay. I thought maybe it was like another year.
But, yeah.
Maybe you counted like before Christ.
Yeah, but we, because a political problem and a big revolution of culture.
Yeah.
So some tradition was destroyed. But in Taiwan, they counting year from they building their country. Their country is Republic of China. But us is People's Republic of China. Yeah. So for them, this year is 114 year. So that's the year of they building their country in 114 years. But for us, we count it like just a way. Great. Well, that's it. Bye. Have a good day. If we have a question, can we email you? Yeah. Bye. You go. Bye bye guys.
Bye. What is that? Mandarins.
You want, because I have kilos of money. Okay. Bye bye. Hello. Where are you going? Hola. Ah. 我不要，谢谢。我今天不吃了，Spicy. Really good. I don't know. I haven't tried it yet. Oh.
Try?
Yeah.
It's spicy?
Yeah.
Can you stand it?
Yeah.
Would you rank for it's like from 0 to 10? 4. Okay, great. What about you, Zubi? If you rank from 0 to 10?
Bye guys.
Bye!
Like a 6 or a 7.
Okay, great.
I can go more spicy.
So you two gonna go to like for your team and sort of thing?
Yeah, yes.
Okay, great. I'm gonna go to like a grocery store to get something. Have a nice day, guys. Bye bye.